Do not be deceived by the current quiet. The financial markets are temporarily dormant, the ticker tape still, the screens dark. Silver's price is fixed at $71.47, creating a deceptive sense of calm, as if the world is pausing for the new year. Yet beneath this placid surface, immense pressure is accumulating to an unprecedented degree. We are currently positioned within the eye of the tempest. Tonight, at precisely 6 o'clock in the evening Eastern Time, the electronic futures market is scheduled to resume operations. As this system reactivates, the substantial capital that has been held in reserve for the past fortnight will surge into the market simultaneously. This is not merely the commencement of a new trading day, it signifies the inception of a new trading year. Within the realm of institutional finance, the inaugural week of the year is renowned for its extreme volatility, explosive potential, and significant profit-making opportunities. This phenomenon is known as the January effect, a predictable market behavior where billions upon billions of dollars from pension funds, insurance portfolios, and hedge fund assets are compelled to rebalance their holdings. This year, these institutions face a particular quandary. Their analytical models are directing them to acquire the most successful asset of the year 2025. This asset is silver. However, a critical scarcity exists. There is insufficient silver available for purchase. The storage facilities are depleted, the distributors have no stock, and the mining companies are retaining their output. Consequently, when this $50 billion influx impacts the market tonight, it will encounter an unyielding barrier of scarcity. Throughout this comprehensive market examination, we will equip you for the opening bell of 2026. We will elucidate the underlying mechanisms of the pension fund scramble. We will demonstrate precisely why the financial institutions that deliberately depressed the price on New Year's Eve are poised to reverse their tactics and aggressively pursue higher prices. Furthermore, we will provide you with a strategic roadmap for the ensuing 48 hours. The countdown has commenced. The funds are prepped and poised, and the price is on the verge of a significant upward movement. This is the narrative of the January squeeze. To comprehend the profound significance of tonight's events, one must grasp the intricate workings of Wall Street's operational infrastructure. Individual investors are driven by emotional responses. They buy when enthusiastic and sell when fearful. Institutional investors, conversely, operate on a temporal basis. December 31st marks the conclusion of the fiscal year. Until midnight last night, the prevailing strategy was defensive. Fund managers divested winning positions to secure year-end bonuses. Banks liquidated assets to reduce their risk quotients. Taxpayers sold underperforming investments to realize capital losses for tax benefits. The entire month of December is characterized by downward selling pressure. However, with the transition to January 1st, the market dynamic shifts to an offensive posture. The tax year has concluded and the pressure to sell has dissipated. Now the process of new asset allocation begins. Every major investment fund maintains predefined target allocations for the new fiscal year. For instance, a fund might aim to hold 2% in commodities and 5% in gold. Currently, they may hold 0 in these categories. Consequently, they must transition from 0 to 5%, and they must do so with urgency. Typically, these acquisition orders are executed within the initial 5 trading days of January. This creates a substantial artificial surge in demand, entirely independent of market news and driven solely by asset allocation requirements. This constitutes a formidable wave of capital that crashes into the market with the force of a tsunami, and this year, that tsunami is of unprecedented magnitude. The reason for this intensification lies in the performance of other asset classes during 2025. Bonds experienced a significant decline, and equities were highly volatile. Silver emerged as the sole outperforming asset. Therefore, the sophisticated portfolio models and algorithmic trading systems employed by financial institutions are uniformly signaling a singular instruction: acquire silver. They are contractually obligated to purchase, leaving them with no alternative. They are now faced with the challenge of channeling their enormous investment orders through the narrow aperture of the silver futures market. To quantify this, consider that the global pension and endowment market manages approximately $50 trillion. Historically, commodities have been largely overlooked by these entities. However, with inflation persistently exceeding 5%, a sense of urgency has emerged. Capital is being redirected from traditional 60-40 stock and bond portfolios into alternative investments. If the global pension system allocates merely 0.1% of its assets to silver, this translates to an inflow of $50 billion. $50 billion in new purchasing power. Now examine the scale of the silver market. The entirety of the planet's annual silver mine production approximates 800 million ounces. At a price of $71 per ounce, this volume is valued at roughly $56 billion. Do you perceive the inherent mathematical discrepancy? The pension funds intend to acquire nearly the entire annual global silver supply within the first week of January. This is an unsustainable proposition. It is impossible to purchase $50 billion worth of silver at $71 per ounce. The physical quantity simply does not exist. Therefore, what is the inevitable outcome? The price mechanism must serve as the rationing agent. The price will inevitably ascend until that $50 billion sum procures a diminished quantity of the metal. If the price of silver reaches $140, that $50 billion will only be sufficient to acquire half of the annual supply. If the price escalates to $280, it will procure only a quarter of the annual output. The price must rise to absorb the available capital. This is not speculative conjecture, it is an illustration of fluid dynamics. When one attempts to pour a gallon of water into a shot glass, it will invariably overflow. Tonight, the pouring of that water commences. The initial indication of this impending influx will manifest tonight, Thursday, at precisely 6 o'clock in the evening, New York time, with the opening of the Globex electronic markets. This is the venue where automated trading systems operate while human traders are dormant. While holiday trading sessions are typically subdued, tonight presents a notable exception due to the continued operation of Asian arbitrage markets. It is important to recall that while New York was observing its holiday, markets in Shanghai remained active and in demand. The price disparity between the United States and China persists. Tonight, the arbitrage algorithms will activate. They will identify the price differential and recognize the availability of attractively priced silver in New York, prompting them to initiate buy orders. This scenario could result in a significant price gap upward at the market open. We might witness silver surge from $71.47 to $73 within the first minute of trading. If this occurs, it will establish the market sentiment for Friday. It will signal to human traders that the period of price decline has concluded and that buying activity has commenced. This will generate a sense of urgency. Any individual who had been awaiting lower prices will realize they have missed the optimal entry point, leading to panic buying. This fear of missing out will further intensify the upward momentum initiated by the algorithms. Now let us address the role of the major banking institutions. Yesterday we detailed how the global systemically important bank, GSIB, surcharge compelled banks to divest silver holdings to enhance their balance sheet metrics for the year-end reporting period. They deliberately suppressed the price to $70.50, thereby achieving their objective of lowering their risk scores and safeguarding their bonuses. However, the critical year-end reporting period has now concluded. The regulatory bodies have completed their assessments and have withdrawn. The banks are now at liberty to resume trading activities. And what is the primary objective of banks in their trading operations? It is to generate profit. They are fully cognizant of the impending capital flow. They understand that the pension funds will be actively purchasing on Friday. Therefore, do you believe these banks will maintain their short positions? The answer is no. They will engage in front-running their own clients. Institutions like JP Morgan are aware that the California Teachers Pension Fund intends to purchase silver tomorrow. Consequently, JP Morgan will acquire silver this evening, buying it at $72 and selling it to the pension fund tomorrow at $75, thereby profiting from the price differential. This indicates that the banks, which were the most significant sellers throughout 2025, are likely to become the most substantial buyers during the initial 48 hours of 2026. They are initiating a strategic shift. The entities that previously suppressed prices will now become catalysts for price increases, aiming to capitalize on the anticipated upward price movement before potentially re-establishing short positions at a later juncture. This alignment of forces encompasses all major market participants. The East is acquiring, the pension funds are purchasing, and the banks are also buying. Who then is selling? The answer is virtually no one. The mining companies are retaining their inventory, the distributors are out of stock, and retail investors are holding their positions. This confluence of factors creates the ideal conditions for a vertical price ascent. Therefore, while the flow of financial capital is aligning, what is the status of the physical metal itself? During the period when the markets were closed today, the underlying physical shortage did not cease to exist. Production at factories in China continued, and the ore extraction at mines in Mexico proceeded. As we enter the new year, it is imperative to examine the physical market disconnect. We will conduct one final assessment of dealer premiums prior to the market opening. Furthermore, we will provide an explanation for why the retail price of silver is projected to surpass $100 in January, irrespective of the movements in the futures market. The clock is ticking. We are mere hours away from the inaugural trade of 2026. If you are observing the market charts at this precise moment, you will see the figure $71.47. This number is prominently displayed on screens in Tokyo, London, and New York. It is the benchmark price that algorithmic trading systems utilize to value derivatives worth billions of dollars. However, I must disclose a crucial truth that the financial institutions will not readily admit: that price is not reflective of reality. It is an illusory price, the valuation of a digital contract traded during a holiday period with minimal trading volume. If you were to attempt to exchange $71.47 for a physical ounce of silver in the real world, you would be met with derision. The paper market is currently operating in an entirely detached and speculative environment, whereas the physical market is experiencing a genuine supply crisis. We will expose the profound disconnect between the digital trading platforms and the actual physical market. We will investigate the activities of bullion dealers over the preceding 48 hours. We will explain why premiums on physical silver have surged to historic highs, even as the spot price has experienced a decline. Moreover, we will demonstrate why industrial consumers, the entities that actually utilize the metal, are already agreeing to pay $80 per ounce in private transactions simply to secure delivery for January. The paper market is poised to reopen, but the physical market never truly closed and is currently signaling a severe shortage. Let us now consider the situation on Main Street this past week. While hedge funds were liquidating paper assets for tax purposes, the general public was actively patronizing coin dealerships. We have received numerous reports from prominent online bullion distributors in both the United States and Europe indicating a complete depletion of their inventories. Typically, the week between Christmas and New Year's is characterized by subdued sales activity. However, this year, sales volume has surged by 300% compared to the previous year. The public, sensing the prevailing apprehension, has observed the market's volatility, encountered headlines concerning national debt, and witnessed periods of significant decline followed by recovery. Consequently, they have made the decision to acquire physical assets. The fundamental challenge lies in the inability of distributors to replenish their stock. The national mints, including the United States Mint and the Royal Canadian Mint, are closed for the holiday period. Wholesale distributors are operating with minimal stuff. Therefore, every ounce of silver sold this week represents an ounce that cannot be replaced until mid-January. The available inventory is virtually exhausted. Consequently, what action did the distributors take? Did they lower their prices to align with the spot market's decline? On the contrary, they increased their prices. If you examine the current premium on a silver eagle coin, it is approaching $20 above the spot price, with the asking price exceeding $90. This price action is a clear indication of the market's true valuation. The spot price suggests an abundance of silver, while the premium indicates extreme scarcity. This divergence represents one of the most reliable indicators within commodity markets. When the paper price depreciates while the physical price appreciates, it signifies a fundamental breakdown in the paper market's pricing mechanism. It implies that short sellers are attempting to suppress a buoyant object that is exerting upward pressure. When the paper market ultimately succumbs to these pressures, it will rapidly ascend to meet the physical price, not converge in the middle. Now let us examine the major players in the physical market, the industrial consumers. We have discussed the January effect in the context of pension funds, but a similar phenomenon exists for industrial sectors, known as procurement season. In January, major corporations such as Samsung, Tesla, and First Solar engage in negotiations for their annual supply contracts. They convene with refiners and miners to establish price and volume agreements for the ensuing year. Ordinarily, these meetings are routine, involving discussions like, "We require 10 tons, here is the price." However, this year, these meetings have devolved into crisis sessions. Refiners are informing these industrial giants, "We do not possess sufficient metal. Mining output is diminishing. Chinese entities are hoarding supply, and recycling efforts are proving inadequate. We can only fulfill 70% of your required volume." Imagine yourself as the chief executive officer of a solar energy company, tasked with doubling production in 2026, only to be informed by your supplier that your allocated silver supply will be reduced by 30%. The immediate reaction would be panic. You would then turn to the spot market and acquire every available ounce of silver, irrespective of the price. $75? Acceptable. $80? Also acceptable. The paramount concern is securing the necessary metal to maintain factory operations. This scenario is unfolding presently. While the broader markets are inactive, procurement departments are actively engaged in communication and are executing off-market transactions, directly acquiring silver from storage facilities in London and Zurich, thereby bypassing the conventional commodity exchanges. This activity effectively removes readily available inventory from the exchange's purview. When the commodity markets reopen tomorrow, traders reviewing inventory reports will inquire, "Where has the silver gone?" The answer is simple. It has been diverted to a solar manufacturing facility in Arizona and will not be returning to the general market. It is impossible to discuss physical silver without acknowledging the significant role of China. While New York sleeps, Shanghai actively consumes. The price of silver in China continues to trade at a substantial premium relative to Western markets, with a differential of nearly $5 observed. Concurrently, while New York was observing its holiday, China enacted new silver export restrictions on January 1st. They are securing their resources while Wall Street is still attempting to locate its access keys. This price arbitrage is a significant contributor to the overall shortage. Each day that New York's price remains lower than Shanghai's, a substantial quantity of silver bars is transported eastward via air freight. This is not a clandestine operation, but a straightforward economic principle. If one can purchase an iPhone in New York for $500 and sell it in Shanghai for $600, the logical course of action is to acquire every available iPhone in New York. This is precisely the dynamic currently at play with silver bars. The Western world is being systematically depleted of its strategic silver reserves, exchanging our heritage for fiat currency, with China willingly absorbing these assets. They recognize that the era of paper-based financial transactions will conclude in 2026, and they aim to possess the tangible assets when the financial music stops. This continuous outflow of physical silver establishes a floor price for the metal. The price cannot decline below the level at which arbitrage becomes economically viable. Currently, that floor stands at $71. If silver's price falls below $71, Chinese buyers will significantly increase their purchases, acting as the ultimate buyer of last resort. This limits your downside risk, as you're essentially investing alongside a superpower that is actively seeking to dominate the market. However, skeptics might argue that if the price is $70, miners will simply increase their production. This is an unlikely scenario. We have previously discussed the supply cliff in our detailed analysis. The establishment of a new mine requires a decade of development. Even at a price of $100 per ounce, the geological processes, permitting procedures, and construction timelines cannot be accelerated. In fact, supply may even decrease in 2026 due to political instability. Consider the situations in Mexico and Peru, where governments are reacting to the prospect of $70 silver by contemplating higher taxation and potential nationalization. When governments take actions detrimental to mining operations, companies tend to reduce investment and, consequently, extraction activities. This leads to strikes and operational disruptions. Therefore, precisely at a time when global demand for silver is increasing, the prevailing political climate is contributing to a reduction in supply. This constitutes a structural deficit which cannot be remedied solely through price adjustments. It necessitates a decade of sustained investment and political stability, neither of which is currently present. Consequently, industrial consumers understand that no additional supply will originate from new mining ventures. Retail buyers recognize that no new supply will be forthcoming from the national mints. The only recourse for acquiring silver is from existing stockpiles held in vaults, which are currently operating at critically low levels. Thus, the physical market is exceptionally tight, distributors have depleted inventories, and industrial sectors are experiencing significant apprehension. However, a more substantial challenge looms on the horizon, a crisis that will render the current supply shortage a minor inconvenience. This is the macroeconomic environment. We must now adopt a broader perspective. We need to examine the impending debt ceiling crisis scheduled for Washington in February. We will analyze the significant unrest within the bond market and explain why the Federal Reserve will be compelled to inject trillions of dollars into the economy in 2026 to ensure the solvency of the government. Silver's price movement is not solely a reaction to a physical metal shortage, it is also a response to an overabundance of fiat currency. We are entering the monetary phase of the bull market, where silver will transition from being treated as a commodity to being perceived as a currency. The physical supply squeeze serves as the igniter, while the monetary crisis acts as the explosive charge. We are witnessing the potential demise of the dollar. We have dedicated the past hour to dissecting the minutiae of the silver market, meticulously counting ounces in vaults, tracking aircraft shipments to Shanghai, and analyzing solar panel production requirements. However, by focusing exclusively on the physical metal, one risks overlooking the larger, more impactful forces at play. Silver does not exist in isolation. It operates within a global economic landscape burdened by approximately $36 trillion of United States national debt. It exists in an environment where the bond market is actively challenging the authority of central banks. It operates in a world where the full faith and credit of the dominant global power are being questioned for the first time in 80 years. At this juncture, we must broaden our scope. We will examine the macroeconomic storm that is poised to make landfall in the first quarter of 2026. I will elucidate why the forthcoming debt ceiling confrontation in Washington will serve as the catalyst that propels commodities to unprecedented heights. We will analyze the actions of the bond vigilantes who are driving interest rates upward, thereby forcing the Federal Reserve to engage in money printing simply to maintain government solvency. Furthermore, I will demonstrate why silver is no longer merely an industrial metal. It is evolving into a monetary life raft. The physical supply squeeze provides the initial spark, but the impending monetary collapse will deliver the explosive impact. Let us turn our attention to the national debt. While celebrations for the new year are underway, politicians in Washington are preparing for a significant fiscal confrontation. In February of 2026, the United States will once again encounter its debt ceiling. We have witnessed this scenario unfold previously: political infighting, threats of default, government shutdowns, and ultimately an increase in the borrowing limit. However, this instance is distinctly different because the interest payments on the national debt have experienced an exponential increase. The United States government is now expending over $1 trillion annually solely on interest payments, a sum exceeding both the defense budget and Medicare expenditures. This situation is mathematically untenable. Consequently, when the debt ceiling negotiations commence next month, the market will likely react with widespread panic. Credit rating agencies such as Fitch and Moody's will issue further warnings of downgrades to the United States credit rating. Foreign governments may cease purchasing treasury bonds due to concerns about a technical default. This situation fosters a crisis of confidence. When investors lose faith in what is traditionally considered a risk-free asset, United States bonds, They will seek refuge in assets that carry no counterparty risk, such as gold and silver. During the previous debt ceiling crisis, gold experienced a notable rally. This time, given the existing shortage in the silver market, such a rally will be significantly amplified. Silver functions as a form of credit default swap on the United States government. As the probability of political instability increases, the price of silver is expected to rise. You are essentially acquiring insurance against governmental mismanagement, and business is booming in this regard. We must now address the bond market, which represents the largest financial market globally and exerts influence over virtually all other markets. Presently, the bond market is signaling distress. Yields are on the rise, and bond vigilantes are divesting Treasury securities, recognizing that inflation is not at 2% but rather at 5% or higher. The implications for silver are profound because escalating yields can destabilize the banking system. We observed this phenomenon in 2023 with the failure of Silicon Valley Bank. Banks rely on bonds as collateral. When bond values plummet, banks become insolvent. If yields experience a sharp increase in January, we are likely to witness another banking crisis. A regional bank may fail, or a larger institution could face significant instability. In such instances, what is the Federal Reserve's typical response? They implement a pivot, abandoning their efforts to combat inflation and halting interest rate hikes. They initiate money printing operations, establish emergency liquidity facilities, and inject substantial amounts of fresh capital into the system to rescue the banks. This is colloquially known as the Fed put. Each time the financial system encounters severe stress, the Federal Reserve resorts to printing money, and each instance of money printing devalues the dollar and consequently drives up the price of silver. We are currently awaiting a systemic breakdown. The bond market is actively facilitating this process by cornering the Federal Reserve into a position where their sole viable option is to inflate away the national debt. Inflation serves as the primary driver for the silver supercycle. While the Western economies grapple with mounting debt, the East is actively constructing an alternative financial structure. The BRICS alliance, encompassing Brazil, Russia, India, China, South Africa, and its recent members, is actively pursuing a strategy of de-dollarization. In 2026, we anticipate a significant announcement concerning a BRICS trade settlement mechanism, a currency backed not by promises but by tangible assets such as gold, oil, rare earth elements, and silver. China understands that to effectively challenge the dollar's dominance, it requires a currency possessing intrinsic value. Paper money is employed as a weapon by the United States, whereas commodity-backed money serves as a protective shield for the BRICS nations. Should silver be integrated as a component within a global monetary reserve framework, its remonetization would be immediate. For the preceding 40 years, silver was perceived merely as a commodity, akin to copper. If it reassures its role as money, its valuation model undergoes a significant shift. Monetary assets command a premium above their intrinsic industrial worth. Gold, for instance, trades at a substantial premium precisely because it functions as money. Currently, silver is being valued at its industrial utility. The prospect of a monetary premium represents the significant upside, and it is the BRICS nations that are poised to implement this premium. Financial analysts on Wall Street frequently discuss real interest rates. Their assertion is that when interest rates are elevated, gold and silver ought to decline in value as they provide no interest yield. This is the conventional economic theory. However, observing the current reality presents a different picture. With interest rates at 5%, silver is trading at $75. This disparity indicates that the textbook theory is no longer applicable. The reason for this is that the market understands the stated interest rate to be artificial. The true interest rate is calculated by subtracting actual inflation from the nominal interest rate. If a bank offers you 5%, but the cost of everyday goods and services increases by 10%, your real rate of return becomes a negative 5%. Consequently, by holding cash, you are experiencing a decline in your purchasing power. Savvy investors are aware of this. They recognize that the Consumer Price Index (CPI) figures are manipulated. They understand that the genuine inflation rate is in the double digits. This explains why gold and silver are appreciating concurrently with rising interest rates, a situation that is historically anomalous. Such an occurrence typically transpires only during periods of currency devaluation. When market participants lose faith in central banks, established economic principles are inverted. We are presently living through such an inversion. To further elaborate, let us examine the second phase of inflationary pressure. The Federal Reserve proclaimed victory, asserting that inflation was subsiding. However, an examination of the underlying cost drivers reveals otherwise. Oil prices are escalating. Transportation expenses are on the rise. Labor costs are increasing. Insurance premiums are soaring. Inflation is proving to be persistent. In the 1970s, inflation manifested in three distinct waves. The initial wave struck, prompting the Federal Reserve to raise interest rates, which led to a temporary decrease in inflation, eliciting widespread celebration. Subsequently, a second wave emerged, which was more severe. This was followed by a third wave, which proved to be the most impactful. We have just concluded the first wave. The second wave is now building momentum. When inflation figures begin to tick upward again in the year 2026, the market will realize that the Federal Reserve is impotent. They will be unable to further increase interest rates, as doing so would precipitate the bankruptcy of the United States government. Therefore, they will be compelled to allow inflation to remain elevated, a strategy known as financial repression. In an environment characterized by sustained structural inflation, assets that cannot be devalued are essential. Silver serves as the ultimate inflation hedge, not only because it is a store of value, but also due to its indispensable role in industry. It offers protection against the debasement of currency through excessive printing and simultaneously benefits from economic expansion. It is the singular asset that yields advantages from both economic scenarios. Consequently, a significant macroeconomic storm is on the horizon. The national debt is insurmountable, bond values are plummeting, inflation is resurgent, and the physical silver market is depleted. What transpires when a match is ignited in a room filled with dynamite? An explosion. However, analysis is rendered futile without effective execution. The analytical phase concludes, and the execution phase commences. We have reached the concluding segment of this New Year's comprehensive investigation. We have meticulously analyzed the $50 billion influx of capital poised to enter the market. We have illuminated the blackout within the physical dealer network and the ensuing industrial panic. We have dissected the macroeconomic superstorm of debt and conflict. Now the analysis ceases and the execution begins. Tonight, the electronic markets will commence trading, and tomorrow morning, the opening bell of 2026 will sound. You are now in possession of the information. You comprehend the rationale. The next step is to understand the methodology. In this final detailed breakdown, I will present the execution strategy for the initial week of January. I will delineate the precise price objectives necessary to validate the supercycle. I will impart the ratio-based exit strategy, enabling you to determine when to secure your profits. And finally, I will offer the conclusive assessment for the forthcoming year. The year of potential has elapsed. The year of realization has arrived. Let us conclude this endeavor. Before the price movements begin, let us examine the chart one final time. The current price is at $7.14. We are presently situated at a substantial support level. Therefore, what are the target price levels for the first week of January? Target 1, $7.50. This represents the prior peak and the critical breakout point. If institutional pension funds enter the market aggressively on Friday, we should surpass $7.50 within the first 48 hours of trading. A breach of $7.50 on high trading volume will confirm the conclusion of the correction. This will serve as the green light. Target 2, $83. This level corresponds to the price spike experienced on Monday during the squeeze. From a technical perspective, prices tend to revisit areas where significant price action occurred. The market will likely test this level again to ascertain the presence of sellers. I anticipate that we will challenge $83 before the end of January. A sustained move above $83 would signify a clear path upward, often referred to as blue sky territory. Target 3. Triple digits. This is the quarterly objective. If the observed shortages are as substantial as the premium suggests, and if volatility in the bond market persists, there will be no significant structural resistance between $83 and $100. It will be a void. The price could ascend from $80 to $100 with greater rapidity than its movement from $20 to $30. Therefore, do not be surprised if we witness a parabolic trajectory in the first quarter. Be fully prepared for such an eventuality. Do not liquidate your holdings during the initial surge. Now, I must engage in a serious discussion with you. Acquiring assets is relatively straightforward. Divesting of assets, however, presents a greater challenge. The majority of investors hold onto their positions throughout an entire bull market only to liquidate them as the market declines. They develop an emotional attachment to the asset, becoming fervent adherents. Your objective is not to become a cultist. You are an investor. The ultimate goal is to enhance your purchasing power. So, when should you sell? You should not sell for dollars, as dollars themselves are the source of the problem. Instead, you should exchange your silver for gold, land, or income-generating assets. We utilize the gold-to-silver ratio as our navigational tool. Currently, the ratio stands at approximately 60 to 1. This valuation remains attractive. Historically, during a bull market, this ratio compresses significantly. When the ratio reaches 40 to 1, you should pay close attention. At this juncture, the easily acquired gains have been realized. When the ratio declines to 30 to 1, you should commence scaling out of your silver holdings. You would exchange 20% of your silver for gold, effectively trading a higher risk asset for a lower risk asset, thus securing your profits. When the ratio reaches 15 to 1, you should exit your silver position entirely. You would then exchange all your silver for gold, or alternatively, acquire a farm or an apartment building. This signifies a transition from speculation to the preservation of generational wealth. By adhering to this strategy, you will be indifferent to the dollar price of silver, whether it is $500 or $5,000. Your sole concern will be its value relative to other tangible assets. Record this ratio. Tape it to your computer. 15 to 1. This represents the finish line. We are on the cusp of entering a speculative mania. A mania is distinct from a mere bull market. In a bull market, optimism prevails. In a mania, irrationality takes hold. You will witness friends and family members, those who previously ridiculed you, suddenly inquiring about how to purchase silver. You will observe YouTube channels, which typically focus on gaming or beauty, suddenly discussing precious metals. This phenomenon is analogous to the shoe shine boy indicator. When this occurs, you will feel exceptionally astute and your ego will undoubtedly inflate. You will perceive yourself as infallible. This is precisely the moment of greatest peril. It is at this juncture that you will be tempted to employ leverage, such as borrowing against your home to acquire more silver. Resist this temptation at all costs. When the mania reaches its peak, your responsibility is to act as the mature, rational individual in the situation. Maintain your composure. Adhere strictly to your plan. Do not succumb to greed at the zenith of the market. You acquired your holdings at a favorable entry point. You have already achieved success. Your current task is simply to safely navigate to a secure landing. Furthermore, prepare yourself for heightened volatility. During a mania, silver can experience a 20% decline within a single day and still remain within an overall uptrend. If you are utilizing leverage, such fluctuations can prove catastrophic. If you hold physical silver, you will merely need to react briefly. Remain unleveraged. Maintain physical possession. Preserve your mental equilibrium. Therefore, here's your checklist for the market opening tomorrow. First, observe the Globex opening tonight. Will it gap upward? If so, demand is immediate. If it gaps downward, it is likely a final deceptive trap. Second, monitor the trading volume on Friday morning. We aim to witness substantial volume, indicating the entry of institutional pension funds. If the price increases on low volume, maintain a degree of skepticism. If the price rises on exceptionally high volume, it signifies a genuine market movement. Third, observe the behavior of dealers. Will their sold out signs disappear, or will they persist? If dealers remain sold out throughout the following week, the short squeeze is poised to accelerate dramatically. Fourth, pay attention to the media. Are they ignoring the situation? Excellent. This suggests we are still early in the move. Are they hyping it incessantly? Exercise caution. Popularity indicates we are nearing a more advanced stage. Therefore, here is the conclusive assessment. The year 2025 served as the preliminary phase. The year 2026 is the principal event. We are experiencing a perfect confluence of factors: industrial scarcity, monetary collapse, and geopolitical conflict, coupled with institutional fear of missing out, FOMO. No force on earth possesses the capacity to impede this trend. The banks have attempted to intervene, and they have failed. Governments have also attempted to exert control, and they have likewise failed. Now the market will assert its dominance. You have diligently conducted your research. You have made the necessary preparations. All that remains is for you to observe. This is the year you have been anticipating. This is the year silver reclaims its rightful position of prominence. Happy New Year. Continue to accumulate, and I will see you on the other side of the market opening.